Hello, everyone. Welcome to Demand Supply Trading Practical Session number 10 for the year 2025. Now, today, as we move ahead with the session, we'll also talk about, the title which you can see for today's session, which says how to catch a falling knife. So the markets have been falling like anything, and I'm pretty sure everyone would have heard that it's impossible to catch the falling knife, or we should not be catching the falling knife. But the problem here is if you don't know how to do it, definitely you should be avoiding it. But if you do know how to do it, those can be your best trades, right? So as we move ahead with the session, I'll show you some of the examples from the ideas that I shared with you in the past and how they worked out for us. Now, before we get started, let's get done with the basic formalities. So myself, Surjit Kakkar, and today is Saturday, 8th of March, 2025. And yes, also make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a Telegram channel, and by scanning the QR code, which is on your screen, you can join this Telegram channel. This is where we keep you updated regarding when these sessions are happening, or if we have any content related to demand and supply, that is what we post. Plus, if you also have some offers coming up, we also post there. So just to be in touch with all the latest happenings, you can be a part of this Telegram channel. There are few different ways to join it. First, yes, definitely you can scan the QR code. Second, if you go to the description, in the description, you'll be able to find the direct link. Plus, once you visit our website, which is surjitkakkar.com, or you can also use the short URL, which is sk.coach. So just give me a second. I'll show you that once you're on our website, just scroll down on any of the pages. And at the bottom, you can see you have the option which says join the Telegram channel. You can click on join now button, and you can join the Telegram channel to be updated. All right. So today's session, like I already said, is practical application of demand supply methodology. So our demand supply course is now available as a 100% free course, which basically covers the theory part. But whatever you're learning in theory, how to apply it practically, that is what we do in these sessions. Now, the best part about these sessions is that we are not looking into something which has already happened, because I say this almost every other session, that it's a piece of cake, something which is already played out. Anyone can pick those charts. You can apply any indicator, any oscillator, and you can find a number of reasons why you would have been a buyer or why you would have been a seller on that particular symbol. But the real challenge and the real beauty is when you are pre-planning this, and that is what we do in these sessions. So we are not looking into something which has already happened. We are looking into what might happen in the future, and that is what we are planning for. And that also helps you build confidence in the methodology, because what I do is I share the examples with you, and when they get triggered in the future, we also review them. So because you are able to see the before as well as the after, that helps you build more confidence in the methodology. And once you have confidence in a methodology, that is the only time you will be more inclined towards understanding it and learning it and then applying it to your trades. So yes, today's session is practical application of demand supply methodology. But I would also add that to be very comfortable with these sessions, you need to have some prerequisites already completed. So let's talk about what those prerequisites are. So the very first one is our Trading Essentials course. It is optional. Why it is optional? Because if you have a good trading background, you can definitely skip. But if you are starting as a fresher, then I would highly recommend you to go through the Trading Essentials course. Even if you have a good trading background, I'll still suggest you to go through the Trading Essentials course, because there might be some nuances which you might, which you might be able to get from those sessions. Now, how to take this course? It's an absolutely free course. And the way to take the Trading Essentials courses, that visit our website. Under services, you'll be able to find courses. Click on courses. And here you can see the very first one is Trading Essentials. Click on Get Started, or you can click on the image as well, and it will take you to our Trading Essentials course. And here you can see that you can start the course in English or in Hindi, with whichever language is comfortable for you. And once you click on this, it will take you to our playlist, which basically covers the complete course lesson by lesson, starting from lesson 1, 2, 3, 4. And once you're done with all the lessons, that basically completes your Trading Essentials course. There is no registration required, no personal information has to be provided. It's just a single click and you have access to the course. So that takes care clear of trading essentials, which is the very first prerequisite. Once you're done with that, the second one is demand supply trading course, because if you don't know demand supply methodology, you will not be able to understand what we are doing in these practical sessions. So to learn demand supply methodology, which now is available as a 100% free course, again on this course page, you can see the second option is demand supply trading. Click on it, and just like before, you have both the options, English as well as in Hindi. And once you click on this, it will take you to the course playlist. You can go through all the lessons. I guess it's about 15 lessons. So lesson by lesson, you can cover the complete methodology, understand what demand supply is, and that basically covers the complete course. Now, what happens is when you go through the course, it is covered theoretically, but unless and until we look into some practical examples, we don't get a very good understanding how it needs to be applied. And that is what we do in these practical sessions. Plus, whatever practical sessions I'm doing, we also keep an archive of it, right? So if you click on YouTube live sessions, it will take you to the archive of the past sessions. So you can watch the past sessions as well, available in both languages, English as well as in Hindi. And the archive is currently over 1 year of session recording. So you have a lot of content available to you. Go through as many sessions as possible, because the more number of sessions you'll watch, the better you'll start having the understanding of the methodology, right? So that basically covers your trading essentials and the demand supply course, both theoretically and also the practical sessions. Now, during the practical sessions, you will see that I use certain documents which help us plan trades in a very mechanical and rule-based way. And these two documents are the demand supply rulebook and the flow chart. Now, how can I get access to these two documents? Very simple. Again, on our website under services, you have the option which says downloads. Click on it. And here you'll be able to find the rulebook and the flow chart. So just click on download and you'll have these documents with you. So that's your rulebook. And this is your flow chart. And during the session, you will see how we use these documents to plan trades very mechanically and rule-based. Now, before we get started with our today's example, now let's look into the trades which we planned in the past and they got triggered, and we'll do a review of them. And after reviewing them, we'll start with our today's example. So I'll start with the example which we carried forward the last session. So the last session, we looked at this example. Just give me a second. Perfect. Which was session number 8. So session number 8, we did the session on the 23rd of Feb, and the prices came into the zone on the 28th of Feb. And the last session we talked about that, yes, we are in the zone. Now, either it will hit our stop loss, or if it starts moving up, we can trail onto it. So this one you can see got stopped out. And I guess in the last n number of sessions, this is the very first trade which got stopped out for us, but that's part of the parcel. And that is something I've been telling you, that no matter what strategy you're using, you will be having winners, you will be having losers. But as long as your reward to risk ratios are in place, net you can be a profitable trader. So we will be closing this now because we carried forward this from the previous session. So this will be now closed and will not be tracking it anymore. The next trade which got triggered during the week, right? So just give me a second. Let me bring that up for you. Is from session number 9, right? So this is from session number 9, which we did the last session. So you can see session number 9 again. When we did the analysis, the chart did not look something like this. When we did the analysis, the chart was looking something like this, right? So if you go through the previous session, which was session number 9, this is what we planned, that is where we have demand area. If the prices, they come to this area, we can plan a long trade. And if you look into it, can you see the low is exactly where we wanted to enter the trade, and since then prices have been moving up. Now, talking about how was the reward to risk ratio when the prices came into the zone, you can see when the prices, they started coming into our zone. I can do a candle replay, which is right here. So you can see when the prices, they, just give me a second. Came into our zone, our opposing fresh area of supply was right here, which is showing us a reward to risk ratio that is 1:1, 2:1, 3:1, a little over 3:1. So reward to risk ratio was definitely not a challenge. We could have taken this trade for at least a 3:1 reward to risk ratio. And what happened during the week, you can see the very next day, it hit our target and we would have got our 3:1 and we would be done with the trade. However, you can see prices have still been moving up. So again, depending upon your approach, if you like to book, let's say, partial profits on your target one and then you want to keep trailing onto it, yes, you could have booked some partial profits and still trailing the position. The second approach is maybe you just want to keep railing onto it as long as possible. Then you would have not booked your profit and you're still in this position. So again, different traders, different approach. But we are going with what I share with you in the rule book and the flow chart. So based on that, at our target one, we would have taken 100% exit, which would have given us a 3:1. So again, you can see the beauty of demand and supply methodology. Like I said, people say it's not possible to catch the falling knife, and you can see we were able to catch the falling knife exactly from the place where it started moving up. And can you see, only when you know how to do this, your reward to risk ratios can be really, really beautiful. Can you see in just about 2 days, you got a 3:1 on this. So that's your session number 9, which we did the analysis the previous session. Now let's look at 2 more examples which got triggered this week. The next one is from session number 5. Just give me a second. I'll bring that up for you. Now, this one is from session number 5. You can see in session number 5, we did some analysis. That's your session number 5. The session was on 2nd of Feb, and the prices came into the zone on the 3rd of March. So we almost came into the zone after about a month. Reward to risk ratio, again, was not a challenge. We had at least a 2:1. So this was a valid trade for us. Unfortunately, prices, again, they went a tad below our distal line, which would have resulted in a stopped out trade, right? So we'll again be closing this, marking it as a stopped out trade. Just give me a second. Let me also update it. Right. So this would be a stopped out trade. And then we have another trade which got triggered during the week. Let's also look into that one as well. And this is from session number 6. All right, so this is from session number 6. Session number 6 was on the 9th of Feb, and you can see prices came into the zone on the 4th of March. So 4th of March, we came into the zone. Again, at the time of arrival, what was our reward to risk ratio? 1:1, 2:1, almost 3:1, right? So we also had a 3:1 on this. So this was also a valid trade for us. And you can see within the week, we also got our target, which is a 3:1. So now if you look into this as an example, right? So like I said, you will be having winners, you'll be having losers. So our session number, just give me a second. Our session example from session number 8 was a stopped out trade, right? So we'll mark it as -1. Our example from session number 9 was a 3:1, right? So we would have got a 3:1 on that. Our example from session number 5 was again a stopped out trade, which will again be a -1. And our example, in fact, this one was a little over 3:1. Now this one is a little less than 3:1. So I'll take an average, both of them at 3:1. So this is your session number 6, which would have given us just give me a second, which would have given us a 3:1. So you can see we had 2 losing trades. We have 2 winning trades. Our winning trades gave us about 6:1, 3:1, and 3:1. Our losing trades took away -2. So we still got a 4:1. And can you see on both the winning trades, we were able to buy almost at the low. And that is why, the thumbnail of the session was how to catch the falling knife, right? So if you know how to do it, yes, you can catch the falling knife, and some of these trades can be your best trades, right? If you look into these trades, let's say a month, 2 months, 3 months down the line, they might be a 20:1, they might be a 15:1, they might be even a 30:1, right? So, but only if you know how to identify where the prices can turn from, you can plan such trades. And that is the beauty of demand and supply. It allows you to take trades with the minimum risk for a very good reward to risk ratio. And that is what I've been saying for a very long time, that the hit rate is never the key criteria of you being profitable. Now, if you look at the example of these 4 trades, we were only right 50% of the times, but we still got a reward to risk ratio of 4:1. And that is what you need to learn, that you don't have to run for a 90% hit rate or a 95% hit rate. You can be right, let's say 50% of the times, but if your reward to risk ratios are in place, net, you can be a profitable trader. All right, so that takes care of the examples which got triggered during the week and one which was getting carried forward. And now that we are done with the reviews, we can start with our example for today's session. So just give me a minute. Let me bring that up. Perfect. Great. So before we get started, we'll again revisit our flowchart. We can also call it as the trade plan or the walkthrough. So whenever we talk about trading, we always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. Title of that video is How to Start Trading. The link is available in the description. In case you have not yet watched that video, make sure you watch it and understand the process, follow the process that I've explained in that video. There is no bypassing it. Eventually, you'll have to do it. So the sooner you start, the better it is going to be for you. So what is my step number one whenever we start planning our trade? Step number one is I need to define my trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade, and the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the stop loss, it can be the target, it can be break even, it can also be the trailing stop loss, any kind of exit. So the question is, why are we starting with the trade purpose as our step number one? And the reason is, when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frames. We start by defining our trade purpose, because logically, the longer I want to be in a trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, when we talk about daily income trades, by default, like I said, daily income means a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, like in these sessions, we take examples from the NSE exchange, which is not a 24-hour market. So I'm pretty sure all of you would have experienced that whenever the market opens, some symbols they'll gap up, some symbols they gap down. And because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But similarly, if you get a gap against you, you can also lose more than what you were willing to lose on that particular trade. So we understand that by keeping a position overnight in a market which is not a 24-hour market, we have that added gap risk, which we would like to avoid as a risk management rule initially. So that is why my recommendation to all of you is initially our hourly dailies should be done as strictly intraday trades. Weekly monthlies, we have no choice. We'll have to keep them as overnight trades because we are not expecting to get the exit the same day. So we'll have to keep these positions as overnight positions. But that does not mean for weekly monthlies, we cannot have gap against us. It can still happen. But since we are leaning against some bigger time frames, the probability definitely reduces. So again, step one is I need to define my trade purpose. Let's assume I opted, I want to plan monthly income trades. Now, once I've selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if I go to page number 28 on the rule book, we start with the topic, which is multiple time frame analysis. Because demand supply methodology is not based on a single time frame. Demand supply methodology is based on multiple time frame analysis. Now, what are the multiple time frames we use for our analysis? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes, like fine-tuning the zone, different kind of entries, like your type 2, type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And in this table, you have the answer. Because I opted, I want to plan monthly income trades. Now I know as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate, used for trend analysis. Daily is the lower time frame. That is where we get our SCTS from. SCTS stands for stop loss, entry, target, and size. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart. Now, mind it, the table which is on page number 31 is specifically for the NSE market, because this market is only open for about 6 hours and 15 minutes. But if you're trading markets which are open for longer durations, like your commodities, forex, cryptocurrencies, then you can refer to the table which is on page number 32. All right, so going back, as soon as I selected my purpose of trade, now I know what time frames I will be using and what is going to be the purpose of each and every time frame. My challenge number 1 is taken care. Now, the next challenge is, yes, I do know my time frames, but if I take the example of NSE itself, on NSE, we have over 2,000 companies listed. So humanly not possible that every day I sit and analyze 2,000 stocks or 2,000 symbols. So what we need to do now is we need to have a process in place which can help me get a smaller list out of a very big list. And the way we do that is by using certain computer programs which are called as scanners or screeners. Now, if you do a Google search, you'll be able to find a number of scanners, a number of screeners, which are based on conventional technical analysis or fundamental analysis, which can help you get a smaller list. But there are no scanners or screeners which are based on demand supply methodology. So that is where I created two custom built tools which help us shortlist symbols purely based on demand supply methodology. And we call them as the alerts and the screener. Now, to understand them better, you can definitely click on this and you can visit our product page and watch the walkthrough videos. But I'll also tell you quickly how you can do it on our website. So once you're on our website under services, you'll be able to find TradingView indicators. And here you can see you have the alerts, you have the screener. So once you click on them and on the product page, you'll have the link to the walkthrough videos. You can watch those walkthrough videos to understand them better, right? So yes, second step is to get a smaller list. How you want to get that small list, it's completely your choice. It can be as simple as I just want to analyze my Nifty 50 stocks. If you want to use conventional technical analysis, fundamental analysis, you'll be able to find a number of scanner screeners once you do a Google search. But if you want something which is purely based on demand and supply, then these two tools are available to you. Remember, irrespective what scanner or screener you're using, they are not call giving or tip giving services. They are some tools which are just helping you get a smaller list. Now, once you have that list, you will have to analyze them one by one. And out of this list, whatever matches with your trade plan is an opportunity for you. Whatever doesn't match with your trade plan is not an opportunity for you. So let's assume whatever process you applied, you got a list. And in that list, the very first one was ABC. So what am I supposed to do next? On ABC, I need to go to the lower time frame. What is my lower time frame? We got the answer from our step number one, that as a monthly income trader, my lower time frame was daily. So here lower time frame will imply daily time frame. And on the daily time frame, I need to identify zone. And by zone, we mean any of these four structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. So let's go to our lower time frame and then start identifying our zones. But I also have another great news for you, that our demand supply zone indicator is now available as a one-time free trial for 7 days. So if you have not yet taken the trial of our indicator, you can try it absolutely free for 7 days. Now, how can you get access to the 7 days free trial? Again, very simple. Once you're on our website and you visit the TradingView indicator page, here you can see the very first one is demand supply zone indicator. So just click on this image. And once you're on this page, you can see you have the option which says 7 days free trial. Click on it. It will take you to this page where you have a form which you need to fill. Only 3 things are required while you're filling this form. First is your email address. The second one is your TradingView username. Now, in case you don't know your TradingView username, there can be 2 reasons for it. One is you simply don't know it. Second, you don't have a TradingView account yet. So if you don't have a TradingView account, you can click here to create a free TradingView account. And once you have created your account, then you can input your TradingView username. If you already have a TradingView account, then you can click here to visit your TradingView profile. And from there, you can identify your TradingView username and you can put it here. And the last one is your full name and submit it. Now, once you have submitted this form, within 24 hours, it will get activated for you. And once it is activated, you will receive a notification on TradingView that the indicator has been activated, and then you can enjoy it for 7 days. So now, since everyone has that opportunity that at least for 7 days, you can try this indicator for free. We will be doing our analysis based on the indicator. In fact, all the examples also that we just reviewed, that was purely based on the indicator. And that also helps you understand the beauty of the indicator. Plus, I also get this question very frequently. Now, how do you shortlist these symbols? I purely use my demand supply zone screener for shortlisting these symbols, which I share with you. So let's start with the analysis part. So our step 3 was to identify the zone on the chart. And now you can see I don't even have to identify it. The indicator has already identified identified this as a rally-based rally for us. Now, some of you might say, okay, this is a red color candle. Why it is identifying it as a rally-based rally? It should be identified as a drop-based rally. And the answer to that question lies in the indicator settings. So you can see in the indicator, you have two options for the leg in. One option is based on the candle type. The other one is based on the candle color. Candle type means whether the candle is a bullish candle or a bearish candle. Now, this is definitely a bullish candle. Even though it is a red color candle, it's a bullish candle. So that is why it is taking it as a rally-based rally. Now, if I say I don't want to do it based on the candle type, I want to do it based on the candle color, now it will change it to drop-based rally. And can you see now your distilled line has shifted to the low of this candle. So again, it's personal preferences. I prefer to do it based on the candle type. The reason is the demand supply methodology is based on price action, and price action is showing us we moved up, we paused for a while, and then we started moving up, which makes it as a rally-based rally. So yes, step 3 was to identify the zone, which you can see the indicator has already done for us. It has identified this rally-based rally for us. And now we can move on to the next step. The next step is the zone available? The answer is yes. Now, once you have identified the zone, doesn't mean you can blindly trade it. There are several factors we have to look into it, starting from these conditions, moving on to the booster scoring. And based on this, if the zone gets qualified, only then we might use it as an opportunity. Otherwise, we would not. So the first thing we'll check is that the zone we have identified, can this be a case of level on top of level? Now, why do we start with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone that has already been identified to a different area. So that is why level on top of level is the very first thing we check. And how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So the first thing we understand is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So first criteria is it has to be a coinciding level. If it is a coinciding level, it might be a case of level on top of level. But if it is not a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone I have identified, does it coincide with any intermediate time frame zone? And here you can see that this is not coinciding with any intermediate time frame zone. And this is also a very good example to understand why it is not coinciding, because some of you might say, okay, Sujit, we do have a intermediate time frame zone and this zone is inside of a weekly zone, so that makes it as a coinciding level. So that's not the definition of a coinciding level. So again, remember what I was talking about. I said if you have an intermediate time frame zone, that is your intermediate time frame zone, and the same zone divides into multiple zones, right? Now this zone is not dividing into this zone, right? So this is a separate area, this is a separate area. If there was a weekly zone here as well, right, on the intermediate time frame, then I would call it as a coinciding level. This is basically test of this previous zone. So remember, this is a test of the previous zone. If there was a formation of a weekly zone, then we would call it as a coinciding level. In this case, it is not a coinciding level, right? So very beautiful example of understanding what to call as a coinciding level, what not to call as a coinciding level. So yes, we don't have a coinciding level. And since we don't have a coinciding level, it cannot be a case of level on top of level. Now, this zone is not because of a gap. Therefore, gap rules will also not apply. Pivot non-authenticity not applicable because we only apply pivot non-authenticity to a drop-based rally or a rally-based drop. Unstable equilibrium also not applicable. So none of these conditions are getting applied to the zone. And if none of the conditions are getting applied, they cannot disqualify the zone. Only if they get applied, then there can be two alternatives. One is qualified, the other one is not qualified. But if the conditions are not applicable, then by default, the zone is qualified for us, right? Because it did not get disqualified because of any of these reasons. So now that we know we have a qualified zone, we'll move on to the next step, which is the booster scoring. So let's bring up the booster sheet and let's start applying the boosters. Let me also draw my 1:1s, 2:1s. All right. So going back to the booster scoring, the first one is freshness. The zone is definitely fresh, gets a score of 3. Talking about strength, we have an explosive move. That is the reason the indicator is marking it. We'll give it a score of 2. Time at the zone, we have 3 candles in the basing, gets a score of 2. And reward to risk ratio will be taking as an assumption because nobody knows how the reward to risk ratio will be at the time of arrival. So at the time of analysis, we take it as an assumption. But as soon as we are entering the trade or we are almost about to enter the trade, we'll just double check, do we have the required reward to risk ratio or not. Now, talking about the location, you can see we just hit a monthly zone, and that is where we are getting the reaction from. So we are not very low on the curve. You can see it is the zone is basically in two areas, which is very low of the curve and low of the curve. So whenever your zone is overlapping two different areas, how do we decide, should I call it as very low of the curve or should I call it as low of the curve? And the answer is we always take it from our entry price. Why? Because that is where we are entering the trade. This is not where we are entering the trade. This is where our stop loss will be. So we are planning our trade low on the curve, which is definitely a good location to plan a long trade, gets a score of 1. Talking about the trend, you can see the indicator also does the zone violation analysis automatically for us, and based on zone violation analysis, it is telling us we are in a sideways trend, which is perfectly fine for us. So low on the curve in a sideways trend, right? So just in case, just give me a second, because this is also a question I get very frequently. So just in case you don't know how to do the scoring, you can always search for boosters, and here you can see that we have all the boosters listed for you. So again, if you are low on the curve and you're in a sideways trend, we'll give it a score of 0.5, right? But I also have an Excel sheet which does this automatically for you. Let's give it a score of 0.5 because the trend is not supporting us. Next is your, I won't say supporting us. It is neither supporting us nor against us, right? So that is why a score of 0.5. Now move from the zone, we need at least 4:1, which has not yet happened. Therefore, we'll give it a score of 0, which might change eventually. Why? Because prices, just give me a second. Because what can happen is prices might move up and then might start coming into our zone. So currently, based on current conditions, we'll give it a score of 0. But at the time of arrival, this can change. It is not a case of level on top of level. It is not even a coinciding level. We have already verified that. And talking about trap, can this be a zone which might work like a trap? Let's take a horizontal line. But the fact is, even if it has to work like a trap, then I'll say, okay, we do have, let's say, just as an example, we have an area of support and resistance. Let's assume here, right? You can see it has been acting like resistance, acting like support, again acting like resistance. So first price has to go above this and only then it can work like an area of trap. So currently that possibility is also not there unless and until it moves up. So we'll give it a score of 0 for trap as well. So if you look at the overall scoring, we have a score of 10 out of 10 for quality with the assumption of reward to risk ratio and 1.5 out of 8 for probability, which makes it as a high quality but low probability trade setup as of now. And a high quality, low probability setup should only be done as a type 2 or a type 3 trade. So yes, going back, after applying the boosters, currently it is a type 2, type 3 trade for us. But yes, conditions can change. In case it goes up, we'll have a score of 2 for the move from the zone. And then it might also work like a trap, which might be a score of 1, which will make it as 2, 3, 4.5. And 4.5 will change it to type 1 trade, right? So that can happen eventually, but currently it's a type 2, type 3 trade for us. Now, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we need to be ready with our proper position size calculation so that if the trade doesn't go in my favor, it goes against me. I should not lose more than what my risk management rule allows me to lose. Wherever the prices are back, you'll have to re-verify that does it still qualify based on my trade plan. If the answer is yes, you place your order based on the entry type, in this case a type 2 or a type 3 trade. And once your order has been executed, the last step is your trade management, where step 1 is 1:1. We make it as a break-even trade. And after that, if we get the opportunity to trail onto it, we start using our trading stop loss. So this is how we plan trades, very mechanically and very rule-based. And if these sessions are helping you with your trades, then do like the video, share it with your friends, family members who are into trading. If you're into some trading groups, you can also share there. And what I also do is at the end of the session, I take the Q&As which you people might have. But before we get into the Q&As, I would also like to add that one feedback which I have been getting from you people is that during the Q&As, I can't share my analysis, right? I can't share my screen. Or what if I don't want to ask the questions in a public forum? I want to do it as a one-to-one session. So for that, now we do have an option available to you. So once you visit our website, you can see on the top you have one-to-one session. You can click on one-to-one, and this is where you can schedule an appointment if you feel that you want to share your screenshots or your analysis or share your screen, then you can go for an online meeting. If you feel that having a telephonic conversation would suffice, then you also have an option for a voice call. So from here you can schedule your voice call or an online meeting, and that is where you can connect with me, and we can also do it one-to-one. But yes, otherwise, during these live sessions, you can definitely post your questions, queries in the chat box. I try to answer as many questions as possible. And let's see what do we have in the chat box for today's session. So the very first question is, which broker are you using for overnight stop losses and bracket orders? See, again, this is not a broker recommendation, but just because you asked me, I trade with Interactive Broker. But again, if you're thinking that having a overnight stop loss, and if the stock gaps against you, the order will get triggered, that is not going to happen. It will only get triggered at whatever the market price is. So if it is gapping beyond your stop loss, your loss will always be a bigger loss, irrespective which broker you're trading with. So it has nothing to do with any specific broker. If it is a gap against you, you will always lose more than what you were willing to lose on that particular trade. But yes, I use Interactive Broker. All right, does SMC really work in market? So I'm not able to understand what you mean by SMC. So if you can just give me the full form of it, then maybe I'll be in a better position to answer your questions, queries. All right. कोर्स बेचने आए हो या फ्री में ज्ञान देने आए हो? So this is on you to decide. I have been sharing my course content absolutely free. So if you feel that I'm giving you the course for free, good enough. If you feel that it's just Gyan I'm giving you for free, then again, it's your call. But I'm trying to share my insight towards how I use demand and supply. And if it helps you, good enough. If it doesn't help you, then probably I'm not the right person for you. Let's see what we have as the next question. Hindi mein kab live aate hain? So we do have a different session, different channel for the Hindi, and that is called as Trading Munch. And today at 2:30 we'll also be doing the Hindi session, so you can subscribe to that channel, which is Hindi channel. The link is also available in the description. So 2:30 we'll be doing the Hindi analysis. Whenever you start the streaming, there will be announced that the stream is starting. So yes, see, like I said, on the Telegram channel, we definitely put it in advance that the session is going to happen on so and so date at this time. So if you want to know it in advance, you can join the Telegram channel. Otherwise, you can subscribe to my channel and keep the notifications activated, in which case, as soon as the session starts, you'll get a notification, right? So those are the two ways. I'm just started trading. Should I focus on 2:1 or 3:1? See, again, everything has its pros and cons. If you're looking for a 2:1, you will get more number of trades. If you're looking for a 3:1, you'll have fewer number of trades. So at the end of the day, you'll have to decide what you're more comfortable with, right? Because you're starting as a fresher, you might want to initially take more number of trades to start getting a hang of it, right? Which is where maybe 2:1 makes a little bit more sense. But once you have a good experience, and then you're comfortable with trading less number of trades, then you want to switch to 3:1, you can also do that. What to do when prices entering the zone forms a risk reward less than 1:1 after executing the trade? So if something like that happens, you have two options. Option number one, if you are, let's say, planning a very aggressive trade, then the good thing would be exit it as soon as possible. Maybe, you just immediately want to exit that position. Second, if you feel that this is not a very aggressive trade, then maybe at 1:1, wherever your target is, you might want to exit. And if you feel that even if the reward to risk ratio has been spoiled, this is at the best location, so the trade might work in my favor, you want to book partial profits and then keep railing onto it, that can also be done. So it will completely depend how conservatively or aggressively your trade setup is placed. Okay, so that answers this query. So it's if it is not coinciding with the intermediate time frame, but it coincides with the higher time frame, then is it a good setup? See, again, if it is coinciding with the higher time frame, then by default we are calling it as the best location. So with the higher time frame, we take into consideration the location. With the intermediate time frame, we are taking into consideration whether it is a coinciding level or not, or a case of level on top of level or not. So yes, being at the best location, whatever advantages we have to give to that trade setup, we do that by even ignoring the trends, right? So with the higher time frame, it is the location. With the intermediate, it can be the coinciding. All right. And whether level on top of level applies to higher time frame? No, for level on top of level will not apply to the higher time frame, only with the intermediate time frame. So that answers your query. If a company is not giving good financial results, but is at a very strong zone, fulfilling our criteria, should we trade it? If I talk about myself, absolutely yes. The fact is, I don't look at fundamentals. So all these examples that I've been sharing with you, I have never looked at fundamentals of any of these symbols. The fact is, I don't even know how to do fundamental analysis. So again, my job as a technical trader is whatever the chart is telling me, I do that. And again, if the company is doing well, then you will get to know it after a while, because once the prices just start moving in your favor, then eventually then you might have news that yes, now the company is doing really, really good. But all those bad newses might be the opportunity to enter into a trade at a cheaper price, right? So personally, I would not care how the earnings are, as long as my trade setup is qualified based on my trade plan. All right, so that takes care of today's session. Thank you everyone for joining in. I will be seeing you now next weekend. Till then, fit safe. Enjoy your Saturday. Take care. Bye-bye.